Welcome to the Genus quarterly video. It's October 24th, so we're going to talk a little bit about what's happened post end of September. Wayne, I'm going to start with, we've often talked about our asset mix models that we've been using for the last 4 or 5 years for an account, a balanced account that has a benchmark of, in their investment policy statement, of 60% equities. We've been over that 60% for years, and at the end of March 2018, that account was at 66%. At the end of June, that account was 63%. At the end of September, 59%. Market action has taken it down to more like 58% today. So we've been selling equities the last 6 months or so. Why is that? What in the models gave you some leading indicators that that was the thing to do?
The signals that were turning negative were the monetary ones. The rates were going higher in the U.S. Money supply was actually dropping. And even in China, we had tight money. So those are some of the precursors of this correction, we think.
Right. So that might make us think about that's why Mr. Trump is all over the Fed for not being nicer and raising, trying to get Powell to reduce interest rates.
Yeah, and he wants a boost going into the election. He wants the market to be up and stuff like this. So it's classic.
But it's interesting. I don't think past presidents have been so aggressive with the Fed.
Not as aggressive. They have signaled, and it's. I think Greenspan came out a couple of weeks ago and said he was actually lobbied by other past presidents. So
interesting.
It's a precedent, but not as vocal.
Right.
And not on Twitter. So.
Yeah. What would make the situation worse that we're in right now? What fundamentals would make?
Well, I still think the 800-pound gorilla in the room is the Fed. The Fed always stops the party, ends the party. And so if inflation keeps moving along, and how far do they want to push this whole thing? So I think the Fed is the one to watch here. They're still talking between 2 and 3 more rate hikes by the end of next year, and depends how inflation goes. They seem to want to normalize rates. That's at least 2 more rate increases. But the housing sector is starting to slow down a little bit. We're seeing a bit of sloth there. Internationally, we're seeing some slowness as well. But they seem on wanting to get to a neutral position here over the next year. So we'll see.
We've had about a 7% top to bottom correction in the S&P 500 so far in the last little while.
Yeah.
Do you think this is? Normal correction, they'd say, is 10%. What are you thinking this one might?
I think we're somewhere in this range here. To the downside, you could get 15%, which would be, sort of a mid-cycle kind of correction. Wouldn't be the end of the world, and that might sort of give the Fed some pause.
Right.
A few China would get broken with that.
Right.
And so it would maybe get the Fed to, be a bit more easy. Going forward, but I'd say the 7 to 10% range is sort of a garden variety correction, which we need and get on an ongoing basis.
So just to be positive for a minute, what do you think would need to happen for our models to get positive again? Just so we're at about a negative 4% signal, what would need to change for us? Well, or how soon do you think they might get positive again?
Well, I would say, I think some events have to take place here that have to, getting to the trade wars would be one good thing. I think at least some sort of visibility in terms of a positive direction there. I'd say in the big.
And do you think that will happen?
I think the China-U.S. trade war. I think the trade war with Europe and Canada and the rest of the world is going to work out with the U.S. I think China is the big issue here. And it's deeper than trade. It goes. It's military. It's intellectual property. It's everything. It's almost another Cold War the way I see it.
Right.
So that's going to be an ongoing, protracted war, and I think life can go on, with that taking place, if the rest of the world is together and maybe putting pressure on China to open up their trade. That plus some sign where the Fed's finished their job and it's going to cool it for a while.
Right.
Would be signs for the market to go higher. And maybe that requires something to get broken somewhere. Maybe in Europe, maybe the market, another downward spike in the market might do that. The housing sector is a bit wobbly right now, but it's still not the end of the world. And the yield curve is still positive. Money supply growth around the world still is around 4 or 5%. Central banks, apart from the U.S., are still expanding their balance sheets. And so liquidity isn't that bad here right now. There's a lot of things to worry about, but markets usually don't end on worries. They usually end on craziness and excitement.
Right. And we still don't like the bond market. So all this when we've been selling equities through this last 6 months, we've been putting a lot of money into cash.
We like the U.S. equity market, U.S. bond market more than the Canadian bond market. I would say the spreads are higher. You're getting paid to even carry carry short-term money there, 2% plus type rates. So that's not that bad. But Canada still looks expensive to us, the bond market here, and we still like stocks more than bonds.
So this is a question I don't know if Canadians realize, but if the year ended today, the U.S. stock market will have outperformed the Canadian stock market for 5 out of the last 6 years. So, and really big difference for 6 years now. When might that change? When might Canada have its day in the sun?
Well,
what needs to happen for that to happen?
We had our hopes up like a year ago. We thought, end of cycle, late cycle sort of playbook is economy gets going. Canada's a beneficiary of that.
Commodity prices
go up. The U.S. economy gets overheated. They outsource more to Canada. That's where we've done well historically. So I still am counting on that to happen at some point in time here. But we've had some hurdles to get through with either the trade war, the problems getting our oil out of the country, for example, is another thing that impacts Canada. But I still am holding out for Canada. We're still in this last part of the cycle. And fundamentally, Canada should be there at some point in time once we get through some of these.
So our fingers on the pulse to buy Canada.
Yeah.
Yeah. And so now I have a question that there's no answer to that we'll be talking about probably more in 10 years than we are today. But I don't want to lose sight of the fact that these deficits are huge in the United States. And it doesn't seem to be a worry to anybody right now because everybody's having fun. But longer term, what do you think the implications of that are?
Well, longer term, there has to be something done to entitlements, obviously, in the U.S. and Canada. I think Canada's ahead of the curve in that regard. In terms of, I think the big plan from Trump and his merry band of supply-siders is to spend some money around, get the economy going, and have a payback, a sort of supply-side payback from lower taxes, and that's going to help the economy grow longer term. Something similar happened actually with Reagan. Reagan's blew the budget out in 84, 85, 86, and then there was a long-term payback from that, I think. So we'll see where that's the big hope that's going to help carry this.
But that's not happening in Canada. We're not getting...
No.
So we just get higher deficits the recipe for increased economic activity longer term.
We
can get a trade from end of cycle, but what sustains us secularly?
I would like to see our post-energy policy in this country in terms of what we have there. I think there has to be some thought given to that.
Right.
I think this cycle is going to be good to oil to the end of the cycle, but what happens after that?
Right.
And there has to be some kind of transition to a newer economy, whether it's high tech or energy efficiency, high tech or something. But
well, we're really getting beyond what happened in the quarter, but these issues do interest me. Well, thank you, Wayne, very much. That we got a little more into the longer term than probably a quarterly video, but it's interesting. So please call your portfolio managers. We'd love to talk to you, and we'll see you next time.